What would happen if Europe's largest budget carrier suddenly withdrew its commitment to Boeing's most ambitious jet deal ever? At the heart of this unfolding drama lies Ryanair's unprecedented agreement to acquire up to 300 Boeing 737 MAX aircraft, an order valued at more than $30 billion on list price terms. For years, the Irish low-cost airline and the iconic American plane maker have tested each other's resolve. Ryanair demanding performance and economies, Boeing striving to deliver innovation and reliability. Now Ryanair is threatening to tear up that very pact. Such a move could send shockwaves through the transatlantic aviation market, upend Boeing's revenue forecasts, and fundamentally reshape the industry's geopolitical alliances. So why would Ryanair, which prides itself on ruthlessly squeezing costs to offer rock-bottom fares, take such a drastic step? And what would be the financial, operational, and strategic fallout for both companies, and for the aviation sector at large? To understand these high-stakes questions, we must examine the size of the deal, the potential losses on both sides, the rippling effects of European-US trade tensions, and the looming presence of a rising Chinese competitor. The enormity of the order and its cancellation threat, Ryanair's proposed acquisition, encompasses the full suite of Boeing 737 MAX variants, each carrying a published price tag of approximately $110 million. Even with industry-standard volume discounts, sometimes reaching 40% for low-cost giants like Ryanair, the headline figure exceeds $30 billion, and some estimates range as high as $35 billion. Airlines typically negotiate steep markdowns on list prices, but the deal's nominal value alone signals the order's strategic weight. To cancel it outright would represent not just a contract dispute, but a fundamental rupture in the long-standing Boeing-Ryanair partnership. Deliveries for the MAX order are slated to unfold over 5 to 8 years, providing Boeing with a predictable revenue stream amounting to several $billion per annum. Boeing's own financial disclosures reveal that its commercial airplanes division generated roughly $23.2 billion in revenue during 2024, against a total company turnover of about $37.5 billion for the same period. Removing a revenue source approaching or even exceeding $20 billion over the contract's lifetime would imperil Boeing's medium-term income projections and could dramatically compress its profit margins and cash reserves. Beyond the airframes, lucrative ancillaries at stake, the impact of a cancellation would extend far beyond the sale of fuselages and wings. Aircraft manufacturers accrue higher long-term profits from spare parts supplies, maintenance and repair contracts, pilot training, programs, simulator services, and software upgrades than from the corner price of the jets themselves. Analysts estimate that, even after deep discounts, Boeing stands to recognize around $20 billion in actual sales proceeds from Ryanair's order, translating into net profits in the $5 billion and $7 billion range once manufacturing and operational costs are deducted. On a conservative basis, Boeing could lose roughly $4 billion in net earnings if Ryanair follows through on its threat, lumpy losses that would be near impossible to replace swiftly. Is Ryanair calling Boeing's bluff? Some industry observers speculate that Ryanair's cancellation threat may serve as a high-stakes bargaining chip. By dangling the possibility of scrapping Boeing's largest ever order, Ryanair could be seeking further price concessions or demanding relief from the additional customs duties that have arisen amid heightened trade tensions between the United States and the European Union. But the airline's leadership has indicated growing impatience, pointing to Boeing's post-737 MAX crisis safety questions and the burden imposed by reciprocal tariffs on imported aircraft components and assembled jets. Should Ryanair decide to walk, however, Boeing's ability to reallocate 300 aircraft worth of production slots to other customers on short notice would be extremely limited, especially as the plane maker works through a backlog of more than 4,000 pending orders for the 737 family. The broader Europe-US trade and aviation landscape airframe orders do not exist in a vacuum. In aggregate, the European Union exports roughly $35 billion annually in aircraft parts and aviation equipment to the United States, while US airborne exports to Europe range between $20 billion and $25 billion. Long-standing disputes over state subsidies to Airbus and Boeing, reciprocal World Trade Organization rulings, and tit-for-tat tariffs have already politicized what should be a smooth commercial relationship. For Boeing, repeated appeals to U.S. authorities for tariff relief underscore how customs levies can increase costs for end customers. An argument Boeing contends hurts European airlines as well as its own bottom line. Ryanair's threat to pivot away from Boeing could heighten calls in both Brussels and Washington for partial exemptions or tariff rollbacks. A Chinese wildcard, Comac's C919, enters the fray. Into this fraught environment steps China's state-backed commercial aircraft corporation, Comac, with its C919 narrow-body jet, a competitor still pending full European certification but buoyed by massive Beijing subsidies. Ryanair's executives have publicly mused about returning to Chinese airplanes if the tariff burden remains unmitigated. Should Ryanair place serious C919 orders, Comac would gain a symbolic foothold in Europe and potentially accelerate approval by the European Aviation Safety Agency, EASA. Yet, certification, pilot training, maintenance infrastructure, and spare parts logistics for a new aircraft type would take years to implement across Ryanair's predominantly Boeing-flown fleet. Legal and contractual minefields large-scale aircraft. Orders invariably include detailed penalty clauses for unilateral cancellation, often amounting to billions of dollars in liquidated damages. Ryanair's hope to invoke force majeure or claim that unexpected tariff hikes constitute grounds for penalty relief would hinge on the specific language of their contract with Boeing, details that remain confidential. Any legal challenge could prolong uncertainty, tying up both sides in arbitration or court proceedings, and delaying resolution of the order's fate. The knock-on effects for competitors and markets Ryanair is far from alone in chafing at trade-related costs. Other European carriers, Air France, EasyJet and Lufthansa among them, are also negotiating with Boeing and Airbus over pricing, delivery slots and tariff exposures. If Ryanair's brinkmanship succeeds in securing tariff concessions or price discounts, rivals may line up to demand similar treatment. Conversely, should Boeing accept a cancellation without major compensation, Airbus could face fresh pressure to cut deals with its European customers, potentially undercutting its own profitability. Stock market sentiment and supplier strains. Financial analysts warn that Ryanair's ultimatum could shave 5% to 10% off Boeing's share price, as investors balk at the prospect of forfeited revenue and renewed questions over Boeing's production stability. Boeing's suppliers, already grappling with pandemic-related supply chain snarls, would confront reduced production rates, threatening factories and jobs throughout the United States. The supplier network underpinning 737 MAX assembly spans thousands of firms. A drop in order volume would cascade across dozens of states. Ryanair's operational gamble. If Ryanair opts to shift fleet allegiance, the airline will confront a host of operational challenges, retraining thousands of pilots, certifying new maintenance procedures, stocking alternative spare parts, and modifying its route network to match the C919's performance profile. EASA certification processes could stretch into multiple years, hampering the airline's ability to quickly phase in Chinese jets. Yet Ryanair's executives may calculate that short-term disruption pales compared with the long-term savings from lower acquisition costs and tariff-free imports. Looking ahead, negotiations, diplomacy, and industry realignment. As of early June 2025, Boeing and Ryanair appear poised for intense negotiations. Political actors on both sides of the Atlantic may intervene, weighing the national economic stakes of preserving a $30 billion deal against the diplomatic imperative of fair trade. If Brussels and Washington engineer a compromise, whether via targeted tariff waivers or transitional subsidies, Boeing could keep Ryanair on board while shoring up transatlantic aviation ties. Absent such a settlement, Boeing risks a major order collapse, with ripples affecting its production lines, shareholder confidence and standing in emerging markets like China. Ryanair, having staked its negotiating leverage on the threat of defection, must balance the allure of cheap jets against the practical headaches of overhauling its air transport ecosystem. In the final analysis, the Ryanair-Boeing standoff transcends a simple buyer-seller dispute. It encapsulates the complex interplay of corporate strategy, international trade policy, and the rise of new aviation powers. Should Ryanair press the trigger on cancellation, it will not only test Boeing's resilience, but also signal to Airbus, Comac, and other industry players that no deal is unshakable. The question now is whether cooler heads will prevail in time to avert a major rupture, or whether this showdown will usher in a new era of fragmenting fleets, fragmented supply chains, and fractured alliances in global aviation.